we could take those dividends and use them to acquire some term insurance using a feature called term additions. And with term additions, all we're going to do, pretty simple here, we have our whole life policy. Let's say a $100,000 whole life policy, participating of course, and it pays out a dividend from time to time. We're going to take that dividend and we're going to use it to buy, just like we looked at in an earlier video, we're going to use it to buy a 1-year, non-renewable term insurance policy. At the end of the year, that 1-year, non-renewable term insurance policy runs out. You might find that on a $100,000 par whole life policy, your dividend is enough to buy $150,000 of 1-year, non-renewable term insurance. So for that period of time, if a death occurs, there will be a $250,000 death benefit associated with this policy. And then next year, you're of course hoping that your dividend will be paid again and it will be used to buy another $150,000 non-renewable 1-year term insurance policy. And then maybe next year the same thing and the same thing. There is the risk though that a dividend gets missed. So what happens if we have a situation where there is no dividend paid? You have a year where there's no dividend. Well, most insurance companies actually offer an alternative here. They'll say, you know what, if you want to take the risk, we hope that you can buy that $150,000 policy every year. But we'll take the risk off your hands if you so choose. And the way that we'll do that is we'll say, you know what, instead of the $150,000, for example, and I don't know exactly what the numbers would be, it would depend on the age of the life insured and the mortality cost of the life insured, but whatever the numbers happen to work out to, maybe instead of $150,000 of coverage that's not certain, maybe we'll guarantee you $100,000 of coverage every year. We'll lock that in. So there is some flexibility here. The insurance companies don't want to pass on unnecessary risk to their insurance necessarily, and in order to help accomplish that, they might allow you to just lock in that amount of insurance. Of course, the insurance company knows that the dividend scale is pretty stable and that they're likely to be paying this out for a good long time. But it does take the risk out of the policy owner's hands. Then we could look at the next participating, or the next dividend option. And that next dividend option was very common in the 1970s and even into the 1980s, less so today. It's called special term additions. And with special term additions, what happens, we're going to do something a little bit similar to what we did here. You might recall from my discussion a few minutes ago that if you buy a $100,000 whole life insurance policy, then it's always going to be a $100,000 death benefit. But at the same time, you are building this cash surrender value. Well, some people look at that and say, you know what, that's not really fair. If I die with $50,000 of cash surrender value, my death benefit's still only $100,000. I'm really not being rewarded for having built up that cash surrender value, or my beneficiaries are not being rewarded for my having built up that cash surrender value. So what about this? What if we could find a way to build this whole life policy such that at the point of death, your death benefit will be $100,000 plus the cash surrender value? Well, there is such an option available. And what we can do is we can take the dividends paid by this participating policy, and we're going to use that dividend to buy just a little 1-year non-renewable term insurance policy. So you buy a little 1-year policy here, a 1-year policy here, a 1-year policy here, a 1-year policy here. Again, you face this risk that if there's no dividend paid, there will be nothing available to purchase that term policy. But for the most part, that's not something that people really considered when they acquired this option, and they just ended up assuming that those dividends would be paid out consistently year after year. Some insurance companies would have guaranteed that even in the absence of a dividend. So you'd have this string of dividends paying out enough to buy a death benefit, a 1-year non-renewable term death benefit equal to your current cash surrender value. And if we think back to that basic structure of whole life insurance, this kind of works because your cash values are growing as that cost of insurance decreases, as you build up more value in the policy, which gives more opportunity for dividends to be paid out. So you typically do have a larger dividend year after year after year as you're committed to your whole life policy. And we're going to take that dividend, we're going to use it to buy that cash surrender value. If there happens to be any excess dividend, we're going to return that to the policy owner in the form of cash. Now, there is another dividend option that sees us purchase more life insurance, and maybe you've figured this out by now, that we've got 1, 2, 3 options that see us invest the money or give it back as cash. We have a further 3 options that are going to see us acquire more insurance. We have a further 3 options that are going to see us acquire more insurance. So the 6th option we're going to look at is called paid up additions. Paid up additions are kind of a neat idea. Here, we can once again work with this idea that we have a whole life policy. Let's say it's a $100,000 par whole life policy. And let's say it pays a dividend. So we take that dividend and we're going to use it to buy a paid up addition. Remember I talked before about a 10-pay or a 20-pay whole life policy where you'd have a very abbreviated premium schedule and then your policy is paid up and no more premiums have to be paid? Well, we're going to do something similar here, but this time it's a 1-pay whole life policy. And what I do is I take my dividend and I buy just a tiny, tiny little whole life policy. This new whole life policy is typically going to have a fairly small death benefit, but it's also going to be a par whole life policy, which means that next year, if there's a dividend, and keep in mind usually there is, so next year if there's a dividend, I'm not going to have 1 dividend, I'm going to have 2 dividends. Now I'll have 1 large dividend and 1 small dividend, but I'm going to take those 2 dividends and I'm going to use them to buy another tiny little paid up whole life policy. So what I'm doing here is I'm increasing the amount of insurance in place. These extra policies are paid up, so I'm not increasing my premium requirements, I'm not increasing my cost of insurance, and I'm building up this pool of investments. If I want to take a policy loan later on, I have this policy, and this policy against which to borrow. When there's going to be a death benefit paid out, the death benefit will be based on this policy, and this policy. So you get to the 3rd year now, and in the 3rd year you have this initial whole life policy, you have this little guy here and this little guy here, and we're going to use all of those to buy another little par whole life policy. So given enough time, you'll see something like this with your par whole life policy. In fact, if you buy this policy on a young child, you can get into situations where eventually you're buying paid up policies that are more than the original death benefit associated with the policy you acquired for that young child at a young age. Paid up additions are generally appropriate where we have a long time to compound. We have a long time to build up that value. For people who are a little bit older, it's probably too late for paid up additions to be really valuable. Special term additions, like I said, are typically used where we have a need or a want to have a death benefit that's equal to the face value plus the cash surrender value. And typically this comes about because of a client's perception that they want to make sure they get back what they put into the policy. Term additions would be used where we want to sell somebody, we have a needs analysis that says, I need $200,000 of life insurance, but they can only afford a $100,000 par policy. Well, you might go other routes, but one route you might go here is you might purchase that policy with the term additions. Your needs analysis shows $200,000 of insurance is needed, So we buy a $100,000 par policy. We know that the insurance company might provide another $100,000 of term coverage. That's our $200,000 death benefits. The savings options are typically used where the client feels that the par policy will help them to build a pool of savings. Often they look on this as kind of an unconscious pool of savings, something that I don't have to dedicate any money to. I'm already paying my premiums on my whole life policy. Now, as an added benefit, I'm going to build up some savings. Cash or check, this is sometimes done by parents buying policies on their young children. They'll choose this option, and then they'll allow that young child, when they get to adulthood or whatever the case is, to start using that money to fund maybe an education or what have you. So there's different reasons why we would choose cash or check. Maybe just the policy owner looks at the history of paying out dividends and says, you know, I'm willing to take that risk. I think most years it'll benefit me to have the par whole life policy. The cash or check that I'll get will be more than my savings if I chose a non-participating policy. Now, there's still one more option, and that is we can just take that premium, take that dividend, and we can use it directly to reduce our premiums. So when we take that amount, we just directly, bang, reduce the premiums, and it gives some savings out of the checkbook for the year. Now, without getting into too much detail here, because we haven't talked about taxation yet, I will show you that when there is some cash associated with a participating whole life policy, as in the case of the first three options, possibly as in the case with the fifth dividend option, and in a sense, although less directly, with the reduced premium options, when we have that dividend paid where there's a cash component or some cash savings to the policy owner, then there are some tax implications for having done so, in the form of a reduced adjusted cost basis for your life insurance policy. We'll talk about that more in a future video when we specifically talk about taxation of life insurance. Now that we've looked at all the features of whole life insurance, I just want to spend a minute talking about who buys whole life insurance. The price for whole life insurance is typically quite a bit higher than a similar amount of coverage for, say, a term life insurance policy, which must lead us to say there's got to be a reason why people buy this thing. Well, there are some good reasons why people buy whole life insurance. Whole life insurance generates excellent savings. The savings or the investment returns are guaranteed in the policy owner's hands. So people look at whole life policies, they say, you know what, that's a nice, stable, guaranteed investment. I don't want to take any chances with my life insurance. Maybe I will invest here and just allow this thing to grow. It's going to cost me a little more money than it would to buy the term insurance that I could buy, but I know it's always going to be with me this way. Whole life insurance is a great estate planning or estate preservation tool. If you have a client who comes to see you, maybe an older couple in their 60s or 70s, and they realize that they need some insurance to pass on an amount to their kids or to their grandkids or to a charity, then a whole life policy can accomplish that very well. Term insurance is not really good for those folks. Term insurance has a limitation, of course, that it's going to run out at a certain age. If they buy a term insurance policy at that late stage in life, it's likely that it's not going to last long enough for them to actually use the policy, whereas whole life insurance is going to be with them for as long as they live. Some folks buy whole life insurance because they like the tax-deferred growth opportunities. Remember that the policy reserve grows on a tax-deferred basis. Some people would buy whole life insurance specifically because they want to take advantage of one of these features. Paid-up additions on policies purchased on the lives of children is a common example of that. Some people would buy whole life insurance because they want that permanent insurance and they want something that's not going to require a lot of management on their hands. You know, when you buy a whole life policy, your only real commitment here is to continue paying premiums. So whole life insurance, it is a little bit more expensive than, say, term insurance. It's certainly not the cheapest product that's out there, but it has lots of great features built in. It can do all kinds of things to adjust to you. You'll recall from back in Module 3, you talked about non-forfeiture options. Well, whole life insurance boasts powerful non-forfeiture options. We can use extended term insurance, we can use reduced paid up insurance, and we can also use an automatic premium loan in the case of a whole life policy, all of which can keep coverage in force long after premiums are paid. So when you're sitting down with a client and they have some cash flow available and they're looking for maybe some tax deferred growth or some good collateral later on, consider whole life insurance. It's a fantastic tool. It's often overlooked today, and it should not be. If you had a client to whom you had sold a whole life policy in 2005, and I stand here in 2010, that client would be singing your praises today. They would not have seen their investments suffer as lots of other people did during this time. I'd like to thank you again for joining us for this portion of the series. Hopefully you have a great understanding of whole life insurance now. This is a fairly heavily tested topic. You absolutely have to understand this both for exam purposes and most likely for your career down the road. Thank you very much. Enjoy your continued studies.